The United States is borrowing a lot of money and creating a lot of debt. And this is a problem because the returns on the bonds they sell are bad, and they have to sell more bonds than are being bought. This puts the Federal Reserve in a difficult position because they have to choose between raising interest and rates to slow borrowing. This ultimately hurts the economy, and markets are producing more money to fill the difference, which causes inflation in goods, services, and financial assets. These are worrying signs, so in this video, let's talk about what the US is currently experiencing and how it's headed to a severe financial crisis. Hey everyone, welcome to Capitalista. Before we get to this, please take a moment to hit the like and subscribe buttons down below. One major issue plaguing the United States is its internal conflict, which can be viewed as war. History has shown that financial stability is key, and spending less than you earn is a simple but effective approach. Unfortunately, politicians often prioritize borrowing and spending to appease their constituents, disregarding the country's overall financial health. This leads to a cycle of borrowing, spending, and leaving the consequences for future generations. And as a result, the current state of affairs requires a distribution of debt, leaving behind a significant burden. Now, have you ever wondered where those checks came from? You see, they came from the government. But here's the catch. The government can't just magically produce money. That's where the central bank comes in. They have the power to create money, and they print a lot of it to tend to the government to produce those checks. This process is called monetization and usually happens towards the end of a long-term debt cycle. It's a sign that a lot of debt has been accumulated and monetized to keep the economy afloat. However, this can lead to its own set of problems. So to understand the warning signs of an impending crisis, it's important to delve deeper into monetization mechanics. One of the key indicators is the selling of bonds. When the market is flooded with bonds, they don't give a good return, and they offer a guaranteed negative return relative to inflation. And this can be a clear sign that trouble is brewing. Inflation index bonds currently yield less than 1%, resulting in a lack of return for investors who hold these bonds. This issue is not just limited to American investors, as international investors are also affected due to the need to purchase more bonds when the government sells more debt. However, this increase in supply may decrease demand for these bonds, leading to a rise in interest rates. This is a typical indication of an end-of-cycle scenario, which puts the central bank in a difficult position. In addition, they must choose between allowing interest rates to increase significantly or printing money to purchase these bonds to keep rates low. And while this strategy may initially lower real rates, it also hastens the depreciation of the value of the dollar. The current economic situation is causing inflation pressures, which could be detrimental to bondholders, including foreign investors. And if people start losing money from bonds, they may decide to sell them. This, combined with the government's need to sell many bonds, could lead to a severe problem. It's like the economy is a person whose pulse is dropping and doctors rush in to give a stimulant to retrieve them. But now that the economy is picking up, there's less urgency to give that boost. However, as interest rates rise, financial assets and particularly bonds may suffer first, followed by stocks. This is a classic sign of a late, long-term debt cycle in the economy. Furthermore, as the impact of a stock market downturn begins to seep into the broader economy, the situation becomes much more complex. A 10 to 15% correction may be tolerable, but tough decisions must be made once the damage extends beyond that threshold. Unfortunately, these decisions are never easy to implement. Should we cut back on the spending with the inevitable consequence of reducing government payouts and putting strain on hardworking citizens? Or perhaps we should look at ways to increase earning potential, which can be a complicated and slow process. This dilemma is particularly acute in the latter half of this year, as multiple factors converge to create a perfect storm of financial uncertainty. Interest rates will rise as inflation and growth pick up, adding to the complex trade-off between the stock market and the broader economy. It's likely there will not be sufficient demand for a particular item, and the key indicator to observe in this situation is the necessity to purchase bonds during economic prosperity. Inflation, both present and future, is a significant concern, as the allocation of funds is a critical political issue issue with extensive spending anticipated. The outcome of this spending will inevitably impact the value of the currency and interest rates. And although the Federal Reserve claims to only slightly exceed their inflation targets such as the 2.5% break-even inflation rate, it is important to note that there are two kinds of inflation. To put it plainly, there are two types of inflation. The one we're most familiar with happens when the economy is doing well and demands for goods and services increases, causing prices to rise. This is normal when there are limited resources and many people want them. However, there is another type of inflation called monetary inflation. This is when inflation continues to rise even when the economy is not doing well, which can cause stagflation, a combination of low economic growth and high inflation. This results in people moving their money out of cash and bonds and into other assets like stocks, gold, and even Bitcoin. The danger lies in the fact that if more people sell bonds than buyers, this could trigger monetary inflation, which is a bigger risk than the usual inflation we see. Printing and hoarding cash may seem like a safe bet, but it's actually not the wisest move. In some countries, interest rates are 0 or even slightly negative, while inflation rates are at 2% or higher. This means that holding onto cash will essentially result in a loss of buying power at a rate of approximately 2% per year. Clearly, this is a significant decline that you want to avoid. Instead, it's better to consider borrowing money and investing in something that has a better interest rate or can offset inflation. For instance, investing in something with an inflation rate of 2% or more a year can help you maintain your purchasing power. However, it's crucial to diversify your wealth to minimize the risk and maximize your gains. Diversification is key if you're low on cash and looking to invest. One area to consider diversifying is in currency and country and asset class diversification. Investing in competitive countries is important, as wealth tends to shift from one asset class to another over time. So rather than focusing solely on specific investments like a 60-40 stock-bond mix or equities, starting with a diversified approach is crucial. It's important to remember that we can't predict the future with certainty, so humility is key. Fortunately, the markets are relatively efficient at making comparisons, so no one investment is necessarily better than the other. So what are your safety plans during a recession? Let me know in the comment section down below. And that's it for today. We appreciate your support and hope you enjoyed the video. Don't forget to give us a thumbs up, hit the subscribe button, and turn on notifications so you never miss an upload from us. Your engagement helps us bring you even more exciting content in the future. Until next time.